Hi, this is Tony Daly from the Santarelli Exchange. And what I'd like to do here is I'd like to show you a little bit how we position ourselves and get ready for an earnings trade or a pre-earnings trade. So what you have here is Amazon, which I believe is announcing earnings on Wednesday or Thursday. But it is definitely this week. So anyway, I've taken the liberty of putting some support resistance and some trend lines on it, only to basically give me an idea of what the stock has done and where I think it might be going. So basically looking here, very simply, this thing has been in a clear uptrend, but it seems to have run into a wall once it got between the 675 and 700 level. So you could see it had a lot of resistance up here. It penetrated it once, but immediately failed, pulled down, gapped down, and then basically has run all the way down to the 550 level and has seemed to have held some support here and bounced up. So I'm going to say that my price target on Amazon, it's going to be very difficult for it to take it past the 680, 690 level here at 682.73. And then of course getting through 700 is going to be huge. So anyway, knowing that that's a potential upside, what's the downside? Well, typically right now the downside, you probably have another 50 points of downside down to this support level over here. So looking at that and knowing earnings is coming up, I'll go to the Analyze tab and I will look to see about how we might want to trade this thing. So we know earnings is this week, and on the Thinkorswim platform, we could look up here. It has some interesting features, but if you don't have them, I'll show you how to, if you don't have the Thinkorswim platform, I'll show you how to do the equivalent. You could see this is the market maker move, and this is what they are predicting based on implied volatility and the rest of the Greeks and all of the different options activity, that Amazon could move plus or minus 44 points on the earnings announcements in either direction. So we have an 88-point potential swing. So that gives you an idea of the word volatility. So it can move an awful lot. You can see the volatility is up at 98%. And the market makers move, the anticipated move for the entire week, which is expiration Friday, which comes in 3 days at the end of 3 more trading days, is a 47-point move, which added to the 44, means that they think after earnings it could move plus or minus 3, but you and I know it could move a lot more than that. Typically volatility is generally understated, so all we're saying is there's a whole lot of risk in here. So how do we get to play this stock and not incur all that risk? Well, one person could say is, well, you know what, I think it's going to go up, so I'd like to buy the at-the-money calls. Well, we could see that the in-the-money calls are the shaded. These are the calls. These are the puts. And then the black background is the out-of-the-money. And you could see these premiums. These are very high. So $27.10 represents $2,710. The implied volatility, remember, every strike has its own volatility calculated through the Black-Scholes model. And if we basically said, you know what, I want to buy this call, fine, let's do it. We'll buy one contract of the weekly January 600 at the money call, and your market they will collect $2,710. Anybody feel like putting out $2,710? Well, that's what it's going to cost you, and that is your max loss. Look what your max profit is. Infinite. Infinite is a long way. So if Amazon goes up 100, you're going to be very happy. If it goes up 150, you're going to be even happier. The odds of it going up 100 to 150 are not that great, but we could actually even calculate what that is. And we do that by the probabilities, which it already gives you. It gives you all of those numbers. So those are things, if we went down to the 440 strike on the put side, which means that it could go down 150 points. The odds of that happening, look at that, about 1%. So it has ways of calculating everything. In fact, analysis paralysis. You can do anything on these platforms, but this is what you need to do. You need to assess your risk. You need to assess your risk tolerance, your account size, and what your expectations are. This theta here, and I'm not going to go, we'll do the Greeks on another class, but this theta here is very important. This theta says that if you buy this call today You wake up tomorrow morning and the stock price hasn't moved, you are already down $257.97. Why? Well, that's time decay. Remember, this basically has no value. This is all the value of time and the value of potential movement, and the market is making you pay up. So you are paying $27.10 for the privilege of owning this call and the privilege of having infinite return if it makes one of these huge, incredible moves, which we don't know if it is or if it isn't. But this is what the market is making you pay for. What would you do if you didn't have this, or if you didn't have all these numbers? Well, here's a trick. The trick is to go to the at the money strike, add up your call and add up your put. Take the two numbers, add them together. Here you have 27.10, 25.65, and you come up with about $43. That's pretty close to me, isn't it? So basically, if you don't have this number or this number on your platform, just simply you will certainly have the cost of the strikes for your at the money. Just add the two up and you will know what the market is pricing in, what they expect the move to be. Now let's say you didn't know if it was going to move up or if it was going to move down. Hey, we can buy a straddle. And if we buy a straddle, we get to buy the call and the put. And now it could go up this way or it could go that way. And we're going to pay over $5,000 for that. We're going to pay $5,200 for that. And our break even in either direction is $52. Well, we're going to be right in one direction. We're going to be wrong in the other direction. But if it doesn't move $52, we just lost $5,000 on that earnings call. Not exactly within my risk appetite, and nor should it be in yours, but I'm showing you all the different things you can do. Now I'm going to show you what you should do. If you want to play Amazon and you want to play in the big boy sandbox, we do spreads. So we basically, if I am bullish, I will very simply buy a vertical spread. And by buying a vertical spread, I am doing a 250 wide strike. So the maximum of this transaction is going to be $250. Can I change it? Sure. If I want to change it, I could change it to whatever I want. So let's say 605. So now we'll get into talking about risk profiles, but what's significant here for you to understand is this line represents risk. This represents risk. And it's telling you that if you go to the upper number, you can make, look at this number here, you can make $252. If it goes down, you could lose $248. So this is basically a 50-50 trade, but it's defined. So if you only do one contract and you pay $2.48, this represents the most you could lose, and Amazon only has to move past 605. Remember this market maker move? This market maker move says that this thing could move $44 either way. For the week, it can move $47. I'm telling you that by putting this trade on, you only needed to move $5. And you're going to pay $2.48. And if it moves more, this is a call, so you've bet the upside. If it goes above 605 at expiration, you will make the difference between the width of the strikes and what you paid. And all you need to do is go look at it, and it says your max profit is $252, your max loss is $248. Now, doesn't sound as exciting as the thousands that I was talking about, but hey, you've got a lot better chance of this stock moving $5 than you do in it moving $44. And if you have the capital and you want to get involved, let's just go up to 10 contracts. Well, now we're in another ball game, right? We're in another ball game. Now we're going to spend $2,400 to make $2,500. So that's the cost of kicking it up a notch, as they say. But you don't need to do that. You could do everything small, and that's what I like. That's what I like, small. Notice, look at the Greeks. We have basically taken them out of the equation. This has now just become a directional trade. It's you and me in the market. If the market goes up, you're not going to have these Greeks tying you down or changing anything on you. It's going to move the price that you want it to. Now, because you have a call, you have a bought call and a sold call, these both have its own set of Greeks, which kind of offset each other. That's why your time decay is not $27, $257. It's only $1.46. Much nicer, much better trade. But not only do you have to be right, you have to pretty much wait till close to expiration for all of the time decay to come out of both of these options. So when I get a lot of questions when they say, hey, my stock is at max gain, how come I'm not seeing the max gain on the risk? And that's because there's still time decay left. So as long as it expires beyond this number, the time decay, it will work for you and you will get your max profit. If you don't want to wait, you could simply just take the profit that it gives you at that time. So hope that's clear because it works for everything. Let's look at another. Let's look at Google. Okay, we're looking at Google. And I'm not going to put all the charts on, but it actually looks eerily like Amazon, doesn't it? It runs up, comes down, hits a base, and moves up. These stocks kind of run lock stock with each other. But anyway, I'm going to do the same thing here. Now we have a $733 stock. Look at our strikes right here. This thing is also going to announce earnings. Don't exactly have the date. I'm not sure when the date is that it's going to announce earnings. Maybe, I think it's got a measured move of $18, implied volatility of 37. And look, it's announcing next week. How do I know? Because implied volatility is going from 31 to 52. So let's take a look at an earnings week trade. Look at how much it wants to move now, $52. So it's looking like Amazon, only even more. So here we go again, 733. Let's look at we're going to buy this call. We go to buy the call, cost you $2,780. You're not going to pay that. I'm not going to pay that. You want to buy 10 of them? Let's buy 10 of them. This is going to cost you $27,000 and your profit is infinite. We don't need to do that, but you could get it exciting as you want depending on the number of contracts. We recommend one here. This is what we do. We keep you in the game. You want to buy a vertical on here? We're going to buy, it's the same thing. It's 250 wide. Now look at that. Your theta goes down to $1. The Greeks are out of the ball game. You're going to pay $1.45, and if you subtract that from 250, you're going to make $1.05. So that's basically how this trade works. You look at it, and here it is. We're going to pay $1.45. Our max profit is $1.05. A little bit less than 50-50. You could play around with the strikes to try to get something that's a little bit more within your liking. If you don't like 735, we could go to 735.50. Now we're $500 wide, and you're going to pay $275 to make $225. The math is very, very easy. Your risk is defined. The Greeks are not going to hurt you, but you do need price to move. This looks just like Amazon, don't you? Because these are all the same. Once you learn one spread, you'll know how to do them all, and we're here to teach you every step of the way. So that's it for this video right here. Remember, we like to spread these things off because it defines your risk. It takes the volatility and the Greeks out of it, and it just becomes a directional play. Before I go, real quick, if you wanted to see a put, you could do it if you think it's going to go down too. We're going to buy a vertical. And here we are. Now we're buying a put. The 730, 727.5 put. So now we want it to go down. This one's going to cost us $1.05 to collect $1.45. Well, why is it more? Well, because the price right now is $7.33, so we have to travel a little bit more. It has to go down a little bit more than the other one. So this one's going to be a little bit better than 50-50 for you, but you get the idea. This is why we teach spreads. This is why we do spreads. This is why we want you to do spreads, and we'll teach you how to do these. If you have any questions, feel free to ask, and thanks a lot. Take care, and we'll see you soon.